Dr. Babasaheb Ambedkar Open University.
Hello and welcome to my all student and dear faculty members and dear friends. I am welcoming you to all of you in the video lecture series conducted by the Dr. Babasaheb Ambedkar Open University in the Chaitanya studio for the course of BBA regular in the subject course, and the syllabus called subject is BBAR 202 Financial Management in unit number 3 in the block number 3. Let us start and begin our session with the working capital management 1. As we learned in a previous session that we done with the meaning and definition of the working capital, what is working capital requirement, what is operating cycle, what are the different sources are there, what are the different approaches are there, what are the different factors are there. Each and everything will be done in that particular session. Now, as we discussed the different types, different approaches, different operating cycle and all this in previous session. Now we move forward to this journey, like in that strategies in the working capital management. So far, the bank are the sole source of the fund for a working capital needs for the business sector. At present, the more finance options are available in the financial management, or we can say the financial manager, to see the operation of his firm goes smoothly. Depending on the risk and return basis, or we can say the risk exposure of a business, the following different strategies are evolved to the managed to the working capital. There are three main approaches are there. First is conservative approach, second is aggressive approach, and third is matching approach. So basically I can say that these three approaches are mainly strategized for the working capital management, that we done and we do the effective risk and return measurement, and we explore our risk at how much level we consider the risk and how much level will be returning in a future. Now let us examine the first approach, that is conservative approach. A conservative strategy suggests not taking any risk in the working capital management and carrying high level of current asset in the relation to the sales. Surplus of capital asset, or we can say the current assets, enable the firms to absorb the sudden variation in sales, production, plant and procurement time without distorting the production plans. It requires to maintain a high level of working capital and should be financed by the long-term funds like share capital, long-term debt, preference share capital, etc. Availability of the sufficient working capital will enable the smooth operation activities of the firm, and there would be no stoppage of production for want of the raw materials, consumables, etc. That means that your operating cycle is in efficient manner. Then sufficient stock of finished goods are maintained to meet the market fluctuation, or we can say the market requirements also, and the higher liquidity level reduce the risk of the insolvency, but the lower risk translate into the lower return. Large investments in current asset lead to higher interest and carrying cost and encouragement for the inefficiencies. But conservative policy will enable the firm to absorb the day-to-day business risk. It assure the continuous flow of operation and elimination, or we can say eliminate the worry about the recurring obligations. Under these strategies, the long-term financing covers the more than the total requirement for working capital. The excess cash is invested in a short-term marketable security, and in a need, these securities are sold off in the market to meet the urgent requirement of a working capital. On that basis, we can say that the financing strategy in a conservative approach, that is a long-term fund, is equal to fixed assets plus total current asset plus part of temporary current assets. In a short-term financial strategy, that is a part of temporary current asset. So here we bifurcate the long-term fund and short term while we taking the financial decision, or we can take the financial strategy. So ultimately we can say that in a long-term fund, the fixed asset plus total current asset and part of temporary current assets are the part of the long-term funds, and in a short term that we considered only and only the temporary current assets. Is it clear, my dear friends? Now let's move on to the aggressive approach, that is the second approach in the strategies of working capital management. Under this approach, the current assets are maintained just to meet the current liability, keeping the cushion for the variation in the working capital needs. The core working capital is financed by the long-term source of capital, and the seasonal variation are met through the short-term borrowings. Adoption of this strategy will minimize the investment in net working capital, and ultimately it will lower the cost of financing working capital. The main drawback of this strategy is that it necessitates to the frequent financing and also increase the risk, as a firm is vulnerable to the sudden shocks. The conservative current assets financing strategy would be go more long-term finance, which reduce the risk of uncertainty associated with the frequent refinancing. And the price of this strategy is higher financing cost, since the long-term rates will be normally exceed the short-term rates. But when aggressive strategy is adopted, sometimes the firm runs into the mismatch and the default. It is the cardinal principle of a corporate finance that long-term assets should be financed by the long-term source, and the short-term assets are mix of a long and short-term sources. For that, financial strategy in a long-term fund and short-term fund is the long-term fund is equal to fixed assets plus part of the permanent current asset, and in short-term the part of permanent current asset plus the total temporary current assets. So here the different strategies for the different approaches are there. So in aggressive, that is a long-term fund is equal to fixed asset plus part of permanent current assets, while in a short-term, that is part of permanent current asset plus temporary current assets. Now let us move on to the third main approach, that is matching approach. Under the matching approach to financing the working capital requirement of a firm, each asset in the balance sheet asset side would be the offset with the financing instrument of the same approximately maturity. The basic objective of this method of financing is that the permanent component of the current assets and the fixed assets would be met with the long-term fund, and short-term, or we can say the seasonal variation in a current asset, would be financed with the short-term debt. Then if the long-term funds are used for the short-term needs of the firm, it can identify and take steps to correct the mismatch in the financing. Efficient working capital management techniques are those that compress the operating cycle. The length of the operating cycle is equal to the sum of the length of the inventory period and the receivable period. Just-in-time approach, or we can say the just-in inventory management techniques, reduce the carrying cost by the slashing the time that the goods are packed as inventories. To shorten the receivable periods without necessarily reducing the credit period, corporate can offer the trade discount for a proper management, or we can say the proper payment. This strategies is also called the hedging approach also. So we can say that the matching approach is nothing but your hedging approach. Is it clear, my dear friends? On that basis, for the matching approach, the financial strategy for a long-term fund is equal to fixed assets plus total current assets short-term, and for the short-term funds is equal to total temporary current assets. So here the three main approaches are there for the strategic analysis of the working capital, or we can say the strategies for the working capital management: conservative, aggressive, and matching approach. And in these three approaches are there are the different financing strategies also are there. Let's move on to the zero working capital approach. This is one of the latest trend in a working capital management. The idea is have to the zero working capital, that is at the times the current asset shall equal to the current liability. That means current asset is equal to current liability is equal to not but your zero capital working capital approach. The excess investment in a current asset is avoided and the firm meets its current liability out of the matching current assets. As a current ratio is 1 and the quick ratio is below 1, there may be the apprehension about the liquidity. But in all, the current assets are performing and accounted at their realizable value, and these fears are the misplaced. The firm saves the opportunity cost on the excess investment in a current asset, and as a bank, cash credit limits are linked to the inventory levels and interest costs are also saved. So we can say this is not but your zero working capital approach, where the current assets and current liability are on the equal basis, or we can say the formulation of a mathematical expectation, that is current asset is equal to current liability. And there would be a self-imposed financial discipline on the firms to manage their activities within their current liabilities and current assets, and there may not be the tendency to borrow or divert the fund. The zero working capital also ensure a smooth and uninterrupted working capital cycle, and it would the pressurize to the financial management to improve the quality, or we can say the quality of the current asset at all the time to keep them 100% realizable. There would also be the constant displacement in the current liabilities, and the possibility of having over the dues may diminish. The tendency to the postpone the current handily payment has to be the curbed, and working causal always the maintained at a zero. The zero working capital would call for the firm for the fine balancing act in the financial management, and the success in this endeavor would get the reflected in the behavior button lines. So we can say that the total current asset is equal to current liability, or the total current asset minus the total current liability is equal to 0. So we can say that this is what zero working capital approach are there. Now, what are the different working capital policies? The degree of current assets that a company employs for the achieving a desired level of a sale is manifested in the working capital folios. In practice, the business concern follows the three forms of working capital policies, which are discussed briefly below as restricted policy, relaxed policy, and third is moderate policy. So basically I can say that in a business or in any firm, they use the three types of policy are there, that is restricted, relaxed, and moderate. Let's move to the restricted policy. That it involves the rigid estimation of working capital to the requirement of the concerned, and then the forcing it to adhere to the estimates. The deviation from the estimates are not allowed, and the estimates will not provide for any contingency or any unexpected event. While the relaxed policy, it involves the allowing of the sufficient cushion for the fluctuation in kinds of the requirement for a financing various item of working capital, and the estimates is made after taking into the accounts the provision for the contingency and unexpected events. Third is moderate policy. The relationship of sales and corresponding level of investment in the current assets is shown in the figure. So we can say this is nothing but your moderate policy. So basically, my dear friends and my dear students, there are the three basic policies are there in a working capital, that is restricted, relaxed, and moderate policy. Is it clear, my dear friends? Let's move to the one illustration that's shown in your study material, that is illustration number 4. That prepare the statement of working capital requirement for the following information. These are the different informations are there, and accordingly you have to prepare the working capital requirements. Particulars given, periods given, and amounts given. In a particulars, the first is purchase of raw material for a 6 week, that is 13 lakh rupees. Then wages 1.5 weeks, 9,75,000. Overheads in that rent and salaries are there, and other overheads are there. Rent for the 6 month 50,000 rupees, salaries 1 month for 4 lakh rupees, other overheads 2 month 3,75,000 rupees, sales cash sales, or we can say the sale for the cash, that is rupees 1 lakh. Credit sale, that is 2 months for 30 lakhs. And average amount of stock and work in progress is rupees 2 lakhs. Not, it is assumed that all expenses and incomes are made at even the rate for the year statement of working capital requirement. Accordingly, we have to enhance and emerge that what is working capital requirement. So we have to calculate a net working capital. So now my question is to you that what you mean by net working capital? Net working capital is nothing but your total current assets minus total current liabilities. Is it clear, my dear friends? Let's move to the answer point. That is, first is your current assets. You have to determine what are the different current assets are there and different current liabilities are there. Okay, my dear friends, let us start the current asset in a question. Here the current assets are given, that is average amount of stock and raw material, that is 2 lakh, and the debtors is given, that is 30, credit sales is given, that is 30 lakhs for the 2 months. So here in the current assets, that is stock and the working process, that is rupees 2 lakh, then debtor, that is rupees 30 lakh for the 2 months divided by 12, because total months are 12. So we can get average of the 2 months, that is a 5 lakh rupees. So total current asset is your 7 lakh rupees. Now moving toward the current liability. So first point is purchase, 13 lakhs for 6 weeks. So here we go 13 lakhs into 6 divided by 52. Why? Because they are giving in a weeks. Okay, my dear friends. Weeks, total weeks are there, so we have to calculate by divided by the 52, and months are there, then we have to divide it by the 12. Okay. Then wages 9,75,000, 1.5 divided by 52. Now moves to the rent, salary and other, that is in a month. So we are calculating and divided by the 12. So 50,000 into 6 divided by 12, 4 lakh into 1 divided by 12, and 3,75,000 into 2 divided by 12. So here you get purchase, that is 1,50,000, wages 28,125, rent 25,000, salaries 33,333 rupees, other overheads, that is 62,500. So you can get the total current liabilities are there 2,98,958 rupees. So these are the two different components are there, that is current assets and current liabilities. Now for the evaluating the net working capital, you have to deduct current assets minus current liability. So 7 lakh minus 2,98,952. So you will be get 4,01,042 rupees are there. So this is called a net working capital requirement for a particular firm. Is it clear, my dear friends? This is a one basic example to cover up the whole working capital requirements of the practical session. Hope you learn well in this video. And next point is for the further reading, but let's sum up with the what we learned in a previous session and what you learn in a today's session. As we start the journey of working capital management for the block 3 and unit 1, for working capital management 1, we discussed the different types of working capital, meaning and definition of working capital, factors affecting working capital, operating cycle, different approaches, different strategies, different policies are there, different requirements of working capital. So this is the nothing but your crux about what you mean by the working capital, how you utilize the working capital in your day-to-day businesses, because ultimately this is a short-term requirement, and short-term requirements may fulfill at that point of time. You may go for the long-term requirements. Okay, my dear friends, so this is what all about the working capital requirements. Hope you learn well in this session. My advice to you all that kindly go for the study material, then watching this video, after that go for the study material, then if you want to study more, then go for this further readings. So you will be get the exact point of view and exact answer for different approaches of working capital and the concept of working capital and how you analyze your skill in the working capital management for the particular company or particular firm or particular business. Hope you're doing well. Hope you enjoyed this video. Thank you very much.